What's up, everybody? Norm Baker. We're going to talk about today insurance, life insurance, right? So, a video ago, we talked about the budget, how it hones our money in so we can, uh, do what we need to do from a bill perspective, right? So, we're not wondering how bills get paid, number one. And number two, more importantly, to build wealth, right? Hones the money in, finds the extra money. We pay off debt with some things. We build an emergency fund, which we talked about before, and we'll do another video in depth later, um, so we can build wealth for ourselves, our families, and our future. Speaking about building wealth for our families, let's get into life insurance. So, what's the point of life insurance? Why do we have it? For the folks of us, like myself, who have children, who has a wife, responsibilities, a home, we need life insurance to protect those people and things, or the people that we love and the things that we depend upon for our families, like a home and that kind of thing, and the income, right? So, who needs life insurance? You only need life insurance if um, somebody depends on you. Um, if you have a wife, right, and you're bringing in the income, and you guys are living off of your income, or if you have a husband and you guys are living and you're living off of, you're the wife and you're living off your income, or the husband living off your income in some way, shape, or form. If you were to pass away, that income would be a hardship on your spouse left behind. If you have children, if you have children that are younger than 18, that are out of your house essentially, and if you were to pass away, there would be a hardship in the household because they depend on that income to live, right? Puts food on the table, clothes on your back, roof over your head, kind of thing. So we need to protect that. We do it through something called life insurance. Now, life insurance, what it's doing is when you pass away, a life insurance company pays your beneficiary, right? The person you decide to gets the money, pays them a certain amount of lump sum. Now, first things first, there are multiple types of life insurance, many, many different kinds, but it all boils down to two things. You pay for a set amount of money for your beneficiary, or you pay for an amount for your beneficiary as well as an amount that's linked to an investment. Those are the basic two. Either it's just life insurance, meaning I die and my beneficiary gets X amount of dollars, 100,000, 500,000, $1,000,000, gets X amount of dollars. Or I die, my beneficiary gets X amount of dollars, and oh, by the way, as I'm alive, my premiums are the payments you make every month to the insurance company. The premiums are going into an investment vehicle. This is the first thing we need to talk about. One traditionally is called whole life. That's the one that is tied with an investment, life insurance with an investment kind of bundle. The other is called term. A certain amount of years, I get a certain amount of life insurance. Once those years are over, life insurance is gone. Okay? Example, 30-year term. If I'm 30 years old, I buy a 30-year term for myself for $1,000,000 for my wife. Between the age 30 for myself and 60, if I die, my wife gets $1,000,000 check. Once I'm 61, if I don't renew and I die, my wife gets nothing. And the other kind, whole life, universal life, it can go up to year 99, right? And it's a bundle of, if I die, I get X amount of coverage, 10,000, 20,000, 50,000. And if I don't die, and at any point in time, I can borrow on the policy because there's an investment vehicle linked into it. Those are the two types: whole life, universal life, term. If you talk to any investment, not even an investment professional, financial coach, financial advisor, financial pundit, everybody knows at this point. Not everybody knows, but it's common in the financial world that whole life is much worse than term. Why? Term is can be a fifth, a fourth, a sixth, a tenth cheaper than whole life. Another way to say that is whole life can be twice as much, 5 times as much, 10 times as much as term in terms of how much actual life insurance coverage you get. As an example, if I were to get $1 million in life insurance coverage for a 20-year term or a 30-year term, that means, like I said before, if I'm 30, but for the next 30 years, if I get, if I pass away, my wife or whoever my beneficiary is gets $1 million. Let's say that's $100. Let's say it's $50. For the same amount of coverage, $1 million for a whole life, universal life, any of these others that have an investment vehicle tied in, same amount of coverage, it may cost $250 as opposed to $50. There's where the 5 times as much comes from, right? You may say, that's okay because I have an investment vehicle with it. Here's the problem. The investment vehicle, you don't get with the insurance. It's an either or. So in a whole life or universal life, if you were to borrow on the policy or take that investment out, that money that they call an investment, take it out, you don't also get the life insurance benefit. You don't get them both. It's an either or kind of thing, right? The reason why that's so much worse is in that example for $50 for a term policy, or $250 for a whole life or universal life policy. The reason it's so much worse is you can take that difference, that $200, and put it into a mutual fund yourself. So then you would have life insurance and a mutual fund. Your investments and life insurance separate. That mutual fund will grow exponentially faster than whatever investment you have in a life insurance policy. Look it up. You guys know we talk about all the time the market's paying 9.6% on average across a 20-year period. Look up in your life insurance policy if you have whole life, universal life, anything that's not pure term. Look up how your investment grows. It shows it in the policy, how it grows over time. It's capped in most cases because the insurance company is investing it in the S&P, getting 9.6%, and they're giving you a portion of that, right? So you're not getting the real investment. So look in your policy if you have whole life. If you don't have whole life, don't worry about it. Just get term anyway. Now, some people say, well, Norm, term ends in 20 or 30 years. What happens then for me? What happens is you need to buy the term and invest at the same time. It only works if you're going to invest at the same time that you have the term insurance. If you're not going to do that, the whole concept of the insurance is it doesn't work in your case, right? Because what is insurance? You're protecting your income in case you pass away, or you're protecting because your income in terms is how your family lives over years and years. So another way to say it is you're protecting the wealth that your income brings until you have the wealth. There are people out there that are called self-insured, meaning if I'm a millionaire and a millionaire, let's say 9.6%, it might be less because we might invest in bonds at that point, but let's say it's 9.6, let's call it 10%. $1 million at 10% will give me $100,000 a year forever on average. If my income at home is $100,000 or less, that's what I need to insure my family. So once I become a millionaire and I have $1 million in cash in an investment vehicle, I don't need to pay for life insurance. Does that make sense? You only insure yourself until you're self-insured, right? Until you have the money that if I passed away, my wife can go in our bank account, take $1 million that's probably already in an investment vehicle, and then just take out the gains every year, right? The appreciation every year, the capital gain every year, right? She lives off the investment. That's self-insured. That's also financially independent. When you live off your investment, right, versus income from like a job or a business, something like that. So, recap. You have whole life, universal life versus term. Whole life will always be more expensive. The investment vehicle inside of it, you don't get in addition to life insurance. It's either or, and the investment vehicle is not going to give you nearly as much as if you took the money and invested yourself. Okay, term is always a way to go. 20 or 30-year term. Okay, for yourself, and man or woman. And a lot of companies do these things called child riders, which we can get into a little more detail. Reach out to me on my website if you want to get in a little more detail on kind of how to structure this term policy for your household. But term is always going to be cheaper, right? For more coverage, which is what's important. And then you would invest the difference between what you would pay in whole life for term into your own investment vehicle. 401ks, Roth IRAs, mutual fund if you've already maxed those out. Again, reach out to me and we can talk more in detail. Okay? So that's the general gist of life insurance. Why it's important? It's important for your family. Right? We're building this wealth not necessarily just for us. I mean, we want to be wealthy, but we've got a lineage that we're building, right? We've got children that we want to come up after us and continue to be wealthy so that when they're in the world, they don't have to think about wealth. I just finished watching Hidden Figures. Phenomenal movie, one of the best movies depicting African American genius that I've ever seen. Okay? And what did they do? Their genius blossomed, right? And through NASA, however it happened, through NASA and other cases, in other movies and other stories, different ways genius blossoms. But that genius was able to blossom. How do we do that? We make sure our children don't have to worry about money. Okay, so insurance, that's that piece. Next video, we'll talk more about emergency funds and details on budget. Reach out to me if you have questions, if you want to work together on this. I'll be more than happy to. I'll talk to you guys later. Peace.